on equity. Chapter 12 handout is on equity valuation. And this is somewhat important, but the chapter 12 homework, only number 4 is required. There's actually 5 questions on it, but number 4 is required. So if you do the other ones, they get counted as extra credit. So even though there's 50 points for number 4, if you do any of the other ones, it adds plus 10 to your score. So there's an additional 40 extra credit points out there for the chapter 12 one. Those will not show up in the My Business course. Those will show up in Blackboard, the extra credit points. Okay. Tonight. The wrong thing. Here's the right thing. Okay, these are just gonna be some of the kind of basics of the equity section. This is sort of like what you might find in a business class when they introduce you to a corporation, how they kind of work. And common stock is the most usual kind of stock that you're going to find. Common stock is common. They have voting rights, which is very important. Variable dividend, it can be anywhere from 0 to 100 or whatever. They are paid after preferred stock. Okay, preferred stock is really kind of an odd duck. And not all companies have them. Preferred stock, I'll talk about that in a second. The biggest thing you're going to find is they have no voting rights and they have a set dividend. So preferred stock, common stock is obviously very common. And the reason is because of voting rights. Somebody has to be in control of the company. So even if you're just a hot dog stand, you have to have at least one share of common stock outstanding because somebody has to be in control. So common stock is required. You're required to have at least one share of common stock. Preferred stock is not required, and many companies don't have any preferred stock. Here's what preferred stock is. It's sort of like in between a long-term liability and common stock. There are some things that are similar to long-term liability, like, for instance, if you take out a mortgage, you have a set interest rate. Same thing with preferred stock, you have a set dividend. So that part's the same. Now that dividend, though, kind of like for the common stock, is not a company is not required to pay it. If you're paying a mortgage, yeah, you're required to pay it. You're signed a document, and legally you're required to pay whatever that dividend is. Whatever the interest rate is. The dividend, however, even though it'll be similar to it says no, we don't have to pay it. If we have a bad year, we can say, look, we can't pay the preferred stock dividends. So it's kind of right in the middle. In fact, sometimes you'll even see if the preferred stock is more similar to a liability. Sometimes it even gets out of the equity section and gets put into the a long-term liability section. So anyway, it's preferred stock is kind of an odd duck, and many companies, I would say probably most companies, don't have any preferred stock. I'd be surprised if it was more than a couple percentage of the companies actually have preferred stock. It is out there. Okay. Treasury stock. Treasury stock is when a company buys back its own stock. And it could be common stock or it could be preferred stock, either one. But treasury stock is when a company buys back its own stock. It reduces the ownership So treasury stock is actually going to be a negative. It's going to reduce the amount of ownership. We're buying back from our stock from previous owners, that we have fewer owners now. And again, it could be whatever, it could be preferred or common stock, but it's stock that we're buying back. This is a huge deal right now. The company's been buying back their own stock for, it's really accelerated. It used to be not as common as it is nowadays. Nowadays, it's very common to have companies buying back their own stock. Okay, oops, you know what okay, excuse me. Par value. Par value is a minimum amount that the stock must be sold for. And this usually goes by the state. Companies are incorporated in states. Every state has their different rules for incorporation. A lot of times you'll see Delaware corporations, or even heard about Delaware corporations. Almost every large bank in the United States is a Delaware corporation. They all go to Delaware and get incorporated. And the reason they do that is there are very lax rules in Delaware, especially for financial institutions. The rules are much more stringent in other states. So if you're running a big bank and you say, okay, I don't want to have all this headache of running our play, whatever, we can incorporate anywhere because we're all over the United States. We'll just do it in Delaware. So Delaware corporations are all those. But anyway, every state has their rules for incorporating. Some states require a par value. Now, a par value is a minimum amount that the stock must be sold for. It cannot be sold for less by the company. It can be sold for more, but it can't be sold for less. Okay, so, and here's why. Suppose I sell stock to all the investors, and I sell it to them for $10 each, and I turn around and sell it to my brother-in-law for $1 each. Okay, to avoid having their ownership diluted, it also helps to protect creditors too, to some extent. To avoid that, they say, okay, you have to have a minimum price. So let's say the minimum stock price is $10 a share. You can sell it for $10 a share, but you can't sell it for less. If you can sell it for 15, that's fine. 20, that's fine, but you can't sell it for less than 10. So par value is a minimum amount. Some states require it, some states don't. So here's how this works. Suppose that we have common stock as a par value of $1. We can't sell it for less than $1. And we sold 1,000 of them for $43. Okay, so here's what it looked like. Our common stock would be on the books for $1. That's the minimum amount. We sold 1,000 shares. So this would be on our books for the common stock. The additional paid-in capital, the true name of this account is additional paid-in capital in excess of par value, which is a little bit wordy. Oftentimes you'll see this called APIC. So additional paid-in capital, you'll often see it just abbreviated as APIC. Even on financial statements for big companies and all that, sometimes they just say APIC. Additional paid-in capital in excess of par value. So the $42 is in excess, right? 43. The par value is 1, so 42 is in excess of the par value. So this would be our additional paid-in capital, or sometimes called APIC. So our common stock would be 1,000. Our additional paid-in capital would be 42,000. I'll be honest with you, I'm not sure why they even do this, because these both go in the equity section, and there's not really too much of a point on either of them. And even though companies have par value, I've seen companies that have par value of a penny. So sometimes even though they are required to have a par value, it doesn't really do anything. But anyway, regardless of that, this is how we do it. So whatever the common stock goes out at the par value, and additional paid in capital is whatever was in addition. Okay. Stock splits. Forward stock splits occur when a company is doing well. I'm doing the spacing here very good. Right. For instance, let's say that we have stock that's trading at $110 a share. It's very expensive stock. And here's why this is the market value of $110 a share, or excuse me, $111 a share is a problem. Stocks will often trade in round lots, and a round lot is 100 shares. So if your stock costs $111 per share and a round lot is 100 times 111 is going to be $11,100. That's a lot of money for someone to get into bank, to buy stock. I want to buy stock in your company. Okay, the minimum amount you put in is $11,000. A lot of people say, well, no, I have like 5,000 here. So a lot of times to get the market price down to where people can buy it, they will do a stock split. And so stock splits are usually done when a company's doing very well. The stock price is increase, but now it's becoming kind of expensive. It's becoming expensive to buy the stock, which can be a problem. You're getting fewer and fewer people that can actually buy the stock. So what they do is they do a stock split, and usually the market is very positive on stock splits because now there are going to be a lot more people that can buy theoretically. With that larger population that can buy it, the stock price will increase even more because now instead of having 50,000 people that can buy the stock, now you have 500,000 people. So stock splits are usually very popular, and they're usually done when a company's doing very well. Their stock price is going up so much that it's expensive. Okay, so that's what we have here. We have a market value of 111, and we're looking at this saying, gee, that's kind of high. And we say, let's split the stock. It's getting too expensive for people to buy it, so let's split it. And this is a 3-for-1. So what happens is for every 1 share of stock, of the old stock, let's call this old. Okay, let's center old. And this will be the new. Center new also. So the old stock before the split, we had common value of 6. Now we're going to take this 1 share of stock though. So every share that has common stock is 6, that has a par value of $6, we're going to take it and break it into 3. So one of them is going to be broken up into 3 of them, and we're going to have to allocate the par value over it. So we're going to divide it by 3. So the new par value will be 6 divided by 3, $2 a share. Now you're going to have 3 times as many shares of stock, but the par value is only going to be $2 now. Number of shares outstanding. Each one of these old shares is going to become 3 of the new. So we're going to multiply . $90,000. And the market value is going to go down by hold on a second. I'm just gonna copy it. And this is really usually what they're actually aiming at, is this last one here. And that is to get the stock down where more people can buy it. Okay, how many people have $11,000? But this will be down to 3,700. There's gonna be a lot more people that have, $3,000, $4,000 laying around, rather than people who have 10, 11, 12,000 laying around. So the idea is that there'll be more people that can buy it. So that's the whole idea behind this stock split. Okay. Now, reverse stock splits. Reverse stock splits are when a company is doing badly. And their stock is usually trading at a very low amount. And it's so low that people have to buy, you can buy 100 shares of it for $300. Right. So, a lot of times when people do trades, they get charged by how many shares they buy. So if you wanted to buy $15,000 worth of this, you'd have to pay commission on a $500 trade to do it. Excuse me, 500 shares of stock trade to do it. So sometimes when the stock price, this is kind of like the opposite problem. The stock prices drop so far that it is such a small amount that you're also having people that are avoiding it. Just because the numbers are huge. How much how many shares of stock do you have to buy if you're going to invest any kind of money into this place? So it's kind of the opposite of the other problem. So they do a reverse stock split, and a reverse stock split says, okay, for instance, in this case, for every 10 shares of stock you have, you'll get one after the reverse stock split. So it's reducing the number of shares. It's sort of just the opposite of these up here. So the common stock par value. Okay, so this is going to be a reverse stock split. So for every 10 of these, you're going to get one of the other ones. So you're going to have to turn in 10 of these old to get one of the new. I didn't need to multiply this. 10 times 1 is. Now the number of shares outstanding, these are going to be reduced because for every one of these, they are going to only get, every 10 of these, you get one of the new ones. So did that again. So divide by 10. So it's reducing the number of shares outstanding. And down here, this is what we're really aiming at. And this is to get the stock price up to a level that most people like to see when they're buying stock. So you can kind of see that these are kind of, I don't know, maybe I should have done these in a different color, but these are sort of the opposite of these up here. So the stock split means you get more shares of stock, the value drops. Reverse stock split means you get less number and you get the stock price to increase, which is what you really want to do. You want it to get up out of this really low area and get it back into kind of like a normal trading amount. Okay. Terminology, results of operations and income statement are the same thing. Earnings statement and income statement are the same thing. This one is a little odd. Financial position and balance sheet are the same thing. So sometimes you'll see, if you're looking at a company's financial statements, they may have these different kind of wording for whatever reason. And anyway, they're the same thing. Time frames. So income statement. So income statement is a period of time. So it might be, oops. So this would be, like an example of a time frame. It could be monthly, every month, it could be January 1st through January 31st, it could look like this. It would be a 1 month. But it's going to be over some period of time. And that's going to be true for most of the statements. Retained earnings and statement of cash flows. The exception being that the balance sheet. The balance sheet will be at a point in time, usually the last day of the period. So and if you think of things on the balance sheet has things like cash, land, equipment, all that kind of stuff, assets. Okay, so the idea is, how much cash do you have at the year end, or at the month end in this case? Oh, wait a minute, I did that one. It should be 31. I'm sorry, let's try that again. So let's say you're making financial statements for the month of January. Everything would be January 1st through January 31st. The exception being the balance sheet would be as of January 31st. So how much cash do you have on January 31st? So it's at a point in time. Okay, yeah, maybe that's some questions. Let's go to the problems. Okay. So here is our, let me make this a little bigger so we can actually read it out loud. Okay, so common stock, let's see here. There's a par value, shares outstanding. So they must have 500,000 shares outstanding, because it's 10 cents per share. And $50,000, so 50,000 divided by 10, that's 100,000. And here's all the other numbers. Additional paid in capital, this is how much they paid in addition to the 10 cents a share. We have retained earnings. Oh, treasury stock. Look at the treasury stock. It's negative. And so all those together equal our shareholders' equity. So this will be the total. Okay, so let's go down here. And these are some of the transactions that occurred. And so what we're going to do is fill in our numbers here for each of these items. So these are the items over here. I'm going to do some. I'm going to copy the arrow again. Okay, so this is number one, generate net income of 700,000. Okay, I think back to our retained earnings statement. This is where we had income. Did we add income or subtract it? To retained earnings. I know this is from this is from week one. Net income we added. I'll give you. So we're going to add net income to retained earnings. Dividends we subtracted from retained earnings. This is in kind of a funny format here. Purchase 10,000 shares of common stock at $3 a share. Okay, so that is 10,000 times 3. $3,000. Okay, now this is treasury stock, and you'll see here, use negative sign with the treasury stock. So this is reducing the ownership by 30,000. We bought this back. Okay, executed a 4-for-1 stock split. That is actually not going to have anything to do with our financial statement, and I'll show you why. Let's see. Let me think how to do this. Okay, I don't know. Okay, the par value was 10 cents a share. Shares outstanding was 500,000. It should not be $1. Well, And so the total equity was 50,000. Now, when we do the stock, was this reverse split? Reverse stock split. Okay, so the par value is going to increase by 4. Shares outstanding is going to be divided by 4. It can be exactly the same. You'll notice that when we do the multiplication, that this ends up being the exact same total as that. So this is actually going to have a 0 net impact on the financial statements. Okay, so let's get our numbers here. Isn't it auto summing? Okay, new plan. Okay. So this is what our new financial statement would look like. And you have one of those in the homework. Same thing here. It's a little bit different. There's a little bit, this one's a little bit, actually a little bit more complex. All right. Oh, this is actually in a little bit different format too. Okay. Net income. 40,000. That would go in our retained earnings. Pay dividends of 10,000 that we come out of our retained earnings. Issued a 10% common stock dividend. Fair value of the stock was $7 per share at the time. Okay. This is a wacky. And I'll tell you why. Instead of getting cash, you're getting extra shares of stock. So the company says, okay, you know, we're not going to pay you cash. We're still going to send you a dividend. And the dividend is going to be in stock. So we're sending out stock to you, and instead of cash. Now, thinking about this logically, generally as a shareholder, you don't care. And here's why. You're going to have the same, if everyone's getting the same dividend, which they have to be, we're all going to have the same ownership after it. You know, if I have 10% ownership, 10% is bad money. What was the end? I forgot what the. Oops. 10%. Let's say I owned, 5% of the stock. If everyone gets 10% more, the ratio is going to be exactly the same. Whatever your ownership was before, it'll be the same thing after. So on the surface, it doesn't look like it's a very big deal. However, a lot of times the market uses this as a positive thing because sometimes the dividend will stay the same. And you'll have these additional shares, so you get more dividends being paid out because there are more shares of it out there. Okay, so let's look at number 3. So number 3, what would that look like? So 10% of the dividend. Okay, so our common stock at par value have 80,000. And that is going to be the same as the number of shares because it's $1 a share. I think the homework problems are like this too. Okay. So the shares outstanding. And we're going to issue 10% more to send out to people. So the stock dividend will be $8,000 shares. And the fair value was $7 each. I'll copy this up. Yeah, I'll do it. Okay, so the total value of this is 56,000. Now, the question is how much of it goes to common stock? Well, the par value is how to do this. We do it different. Okay, par value. And so those are going to common stock. Stock dividend, additional paid in capital. The additional paying capital was 6 because the total value was 7. So the additional was 6. So here's what this is going to look like. It's going to come out of dividends. Oops. These will be the same. So out of dividends, we'll take 56,000. Common stock will get an extra 8,000. Additional paying capital will get 48,000. You'll notice that the actual equity section really hasn't changed. And theoretically, nothing's happened. Theoretically, it's not. This is exactly, same. You just kind of shuffled it around a little bit, taking some out of retained earnings, put it into common stock and additional paying capital. Okay. Declared and issued a 2-for-1 forward stock split. Okay, the thing we're gonna have to pay attention to on this one is the par value. So the par value is $1 per share. And we're going to divide that by 2. That's going to equal 50 cents per share. So the new par value is gonna be this. Now, we don't have to do anything down here. It's not gonna change in total. It's still gonna have, that's the wrong number. Change that. Add the wrong number in for the common stock. Okay, coming down here. So the forward stock split doesn't really matter as far as the total is concerned. We had what, 88,000. Now we have twice as many shares of stock outstanding. It's not going to matter. You're going to have twice as many, but they're worth half as much. So in total, it's not going to do anything. This will just be a 0 for this one. Okay, down here, converted 100 shares of preferred stock with a book value of $50,000 into 3,000 shares of common stock. Okay, so we got to take 50,000 out of the preferred stock. Is that right? Yep, 50,000. Common stock. Oops, I got that in the wrong line. Common stock. $3,000 shares of common stock. Okay, so this will be, where to put this? Over here. So 3,000 times 50 cents. What's 3,000? 1,500. And so the rest of that 50,000 will be in the additional paid in capital. So preferred stock went down by 50,000. Common stock. Oh, you know what? Wait, I did this wrong too. Common stock, the number of shares. No, I did that wrong. This is right. This is right. I was thinking this was the number of shares. These are the number of same as the number of shares, but only because it's one part, right? Okay, never mind. Oopsie daisy. So anyway, we got another 1,500 worth of common stock and 4,500 of this. So this is what this would look like. Do we not do anything with treasury stock? Nope. Okay. You notice that the net impact on the equity section for these last three are 0. Okay. Dividend payout. So dividend payout is how much of the earnings per share are paid out. Earnings per share is when you just take the well, here I'll show you what it is. You want to do this one? Well, they both have split. Well, I'll take this before the split. They had income of 40,000. So earnings per share is okay. If you have income of 40,000 and you have outstanding shares of 80,000. Like at the beginning of the year here, you know, the earnings per share would be 40,000 divided by 80,000 would be 50 cents. This would be the earnings per share. So how much did they earn for each share? Now, the next question is, well, how much do they pay out? So let's take a look here. So this is what they're paying out, the dividends. The earnings per share is how much did they each of those earn? And the market price per share is what was the market price of it. And oftentimes these will go, they'll be part of a trend. You know, the more earnings you have, the higher the market price, the more dividends, the higher the market price, that sort of thing. Okay. Conserve a little space here. Okay, so one of the things that we always try to do is go, okay, what are the payout for dividends per share? So what is this, year one? Like the way that looks. Okay, well, whatever. Okay. So dividends per share. $5. And earnings per share was $1.33. So they're paying out 3%, almost 4% of their income is getting paid out to dividends. Okay, now you might say, well, okay, how much are we actually making on the stock price? Because the dividends are the cash coming in. And the market price is what the market is saying that the stock is worth. So the actual return on your stock, if you're getting paying $18, you're getting a 5-cent dividend is 0.28%. Okay. And we do the same thing here too, see how that changes. And it's going up a little bit. The dividend, the dividend payout is going up a little bit on it. A little bit higher payout. And we come down here. And it jumps up even again. Wait a minute, did I do that right? No, I did not do that right. That's not the earnings per share. There we go. So the dividend payout actually jumped up quite a bit as far as percentage wise here. Okay, so dividend payout. And dividend yield, and it's not uncommon to have pretty small dividend yields, especially on a growing company. It might be zero if they don't pay any dividends. For years, McDonald's would pay zero dividends because, like in the 70s, they were growing so fast that, the company was growing at 20% a year, and so they say, okay, we can pay out dividends. And you can go put it in your bank and make 1% or 2% on your money, or you can leave it with us and make 20%. So even though they didn't pay dividends, investors flocked to them because the return was so high that they would rather keep the money in the company until once it kind of leveled off and they start paying dividends. Okay. And I have to unhide this. Which seems to be driving fun times share price movement. Okay, and it could be that it's being moved by the dividends or the earnings per share, and it really kind of depends on the company. Okay, so the question is, how much did this stuff grow by? Okay, so for instance, by year 3 it was at 14. Year 1 it was 5. I'm gonna put this in a percentage just to, yeah. And I'm just gonna copy this down. Now notice a couple things here. They're saying what seems to be driving the share price movement. So here's a market price per share. So they're asking about this one in particular. What is driving that? Okay, it's most likely driven by the earnings per share, because the earnings per share is pretty close to that. If it was driven by the dividends per share, it would have jumped up quite a bit. But it didn't. It didn't increase by 280%. It increased by 130. Earnings per share is 129, close to 130%. So in this case, you'd probably say, okay, it's probably the earnings per share. It's more likely it's more closely related to it. Okay, so that is number 11. It kind of beats up the the equity section of the financial statements. Okay. Do you guys want to take a break, or do you want to just push on through? Or right here. I can tell you that chapter 12 only takes like, I don't know, 5-10 minutes.
We can keep going.
Okay. All right. Chapter 12 is a the idea is, how do you find the free cash flow? This book uses one way of showing that. This is not necessarily how you'll see it in other books. The weird thing about the one that we're going to show you, though, is that you can actually do it 3 different ways and get the exact same amounts. And you kind of see why as we go through it. But there are different definitions about free cash flow. And I think I mentioned to you earlier, maybe I didn't, that when it comes to analyzing financial statements, there aren't any set rules. You know, you can use whatever concoction of formulas you want. So sometimes you'll have different authors of books having different methods of, you know, finding, for instance, in this case, free cash flow. They'll have different ways of doing it. Some are theoretically better than the others. Sometimes it's, you know, flip a coin. But anyway, the one that the author uses, there's 3 different ways of doing it. So the idea, I guess, is whatever information you have, you can kind of use it to figure out what the free cash flow. And free cash flow is basically, what can you spend? How much money do you have that you can actually spend on things that isn't spoken for, that it isn't going to go to paying off the bills and that kind of thing? How much money do you have left over, you know, during the year to actually do stuff with? So that's the free cash flow is. And obviously, the more free cash flow you have, the better you are at paying your bills and taking advantage of opportunities and all that kind of stuff. Okay, so what I'm going to do is I'm just going to take all this data and I'm just going to move it down here. Tighten it up a little bit. Okay, so this data is exactly the same as this, and this is some of the data that we need to put into our formulas over here. And this is there's 3 different methods, and they'll give you exactly the same. They should give you exactly the same amount. Okay. The first method says dividends paid less issuance of common stock will give you free cash flow. Okay, cash flow from operations. Less increase in operating cash flows. Plus cash flows from investing. Actually, that's plus increase in debt. That right? I don't think it's gonna come out right. Hey, it does come out right. I can tell you why it does that. Basically, what it's saying is this increase in cash and operating cash is total amount. And what you're doing is backing out the operating and the investing, and then also the debt part to get back to this, which is just the equity section. I know it's a long way around the block, but it's sort of like taking this amount and subtracting out everything else in the statement of cash flows to make it equal to this. And you can also take net income less increase in common equity. And increase in common equity, the net income falls out because it'll be in the statement of retained earnings. So this 4,500 will also be offset by a 4,500 in the minus of the increase in the equity. However, the dividends will then be what the increase in the equity is all about, and that will be 900. So the wacky thing about this, the one that the book uses, is that there are actually 3 ways to do it. Question on that thing? Okay. Well, that's it for the class. Now remember this chapter 12 homework. So number 4 is going to be similar to what we did on the chapter 12 handout. The other parts of it are a little more in depth. You can look them up, you can do them. And there'll be extra credit if you do them. They're 10 points each. You don't have to do them, obviously. The extra credit points will not be in my business course, they'll be in Blackboard. Okay. Question? Is it good? Okay, well, I'll be around all week, so if you have any questions as you're going through the homework or the test, feel free to. I think you're due on the 17th. If for some reason you have difficulty getting to that one, let me know. And there is a little bit of leeway after the grades are entered. I think it may be like a weekish or something like that. So that if you really had a hard, you couldn't get in or whatever it was, something came up. It is possible that oftentimes what I'll do is I'll put a grade in, because sometimes even if it's not the grade you want, let's say it's a B and you're trying to get that A, I'll put the B in because that will open up the other courses that you can actually take. If I put in an incomplete goes in basically as that you haven't completed the course. But if there's a grade in there, that will usually open it up so that you can go to the next course, and then we can go back and redo the grade changes, get the stuff in. Any questions? Okay, well, great having you guys, and again, you have until the 17th, which I think is what's it, Monday? Yeah. So Monday to get it all in, and I will put in the grades after that. Your grades will be posted in Blackboard. I'm going to try to go through pretty much every day to update the Blackboard so that it matches what's in the My Business course. Just to kind of, so people know where they're at throughout the week. Questions? Okay, well, thanks for having you guys, and hopefully I'll see you again.
Thank you.